Everything you need to know about RMDs and why. Why do we have to take an RMD? What are they? And when do they have to begin? There's a lot of information to really unpack as it relates to RMDs. So we'll start with what is an RMD and why do we have to take these things?
It's like alphabet soup, RMD. Well, required minimum distribution. Many of you that are in the heart of your working years, maybe 30, 40, 50 years old, you don't even have a reason to know what an RMD is, but that's going to come later and you're going to really want to know. And actually you want to know now before it's too late. Required minimum distribution. So you put money into that 401k, that IRA, that retirement account, and it gets to grow tax deferred, which feels like tax free, but it isn't. And it continues to grow. And you never think about that someday someone is going to make an obligation to you that you have to pull out a certain amount of money every year. And they dictate what that is, and it changes. And there's all kinds of things to know about that. But many of you don't even understand what an RMD, or required minimum distribution, is. But again, the IRS is going to give you a tax break during your working years, but then when you turn a certain age, they're going to make you take money out because they want to get their pound of flesh. They want to get their taxes that they have let you delay all of these years, and that's what a required minimum distribution is. And Dan, they've changed the age and some of the rules. Go into that a little bit so we understand how that works.
Well, so if you have this pre-tax IRA, 401k, 403b, other kind of retirement accounts, and you have the pre-tax money in it, essentially, to your point, Pete, the government wants us to pay the piper. Right? You haven't paid tax on any of those dollars, and before you die, they're coming for their tax dollars. So
they're coming for you.
It used to be 70 and a half, the year that you turn 70 and a half.
Too. Right. Who comes up with that?
Well, it has to be in their favor one way or another, right? I mean, I'm just going on a limb, but I got to think whoever came up with that benefits them, adds in a whole nother. But anyway, so 70 and a half, that's when it was. They recently changed that now to the age of 72. You have to begin these required minimum distributions at age 72. Another question we get asked a lot is, how much am I going to be required to pull out? And there is a life expectancy factor table that you can look at, but essentially there is a way to break that down to a percentage. So whatever the value of the IRA or retirement account is on December 31st, they're going to take that and multiply it by this factor, and that's going to tell you exactly how much you have to take out. I can tell you from the years that I've worked in this career and the clients I've met with, nobody gets to age 70 and a half or now 72 and is excited about the government forcing them to take money out
and paying taxes
on, because most of the time they don't want all that money.
No,
they don't need all of that money, but the government's going to force them to take it out, which can also throw you into a higher tax bracket.
So if your RMD is $35,000, but you only need $20,000, you'd rather keep that 15 in there if it was just all up to you, but it isn't all up to you. And that percentage changes as your years go up. And the older you get, you'd think you'd need more money, and some people do, but a lot of times they're not traveling as much, trading in their cars, paying as much gas. They don't even eat as much as they get older.
Yeah.
And so they don't need that money. I've seen clients that have actually had to pull out $100,000 or $120,000 in a year, and they didn't need any of it. So planning for this ahead and knowing how it works, very important.
That's right. Be prepared for it. Don't get caught off guard. So the way that it works, again, in the year that you turn 72, it's the year you turn 72. It doesn't matter the month.
Right.
It's the year you turn 72. You have to take a distribution based on what they tell you by the end of that year, December 31st.
Right.
Another little caveat they've thrown in. In the first year of your RMD, you can delay that RMD until April of the following year. Okay, so you can delay the first year
until
until that means you'll have to take 2 RMDs that year. One for the prior year, one for the current year, and they both get hit on the same tax return.
Not going to be the best thing for most people.
Rarely is that a good scenario to double up a higher taxable event in one tax year. But that's the rule, right? Have to take every year after, you have to take it before December 31st. So age 72, you can delay till April, not usually recommended, and then by December each year. But so for some of these people that have to pull money out, they don't want to take it out, the government's forcing them, we've got to pay taxes on it. Is there a way to potentially reduce the amount that we have to pay taxes on for those RMDs?
Well, more alphabet soup, more of these QCD, RMD. So there's another acronym, Qualified Charitable Deductions, QCDs. So when you turn 70 and a half, so if it wasn't complicated enough, we're going to make it more complicated, because now they actually will allow you to pull out money that goes directly to a charity. Now you have to do this right. You need to read up on this and figure out exactly how to do it. But if the money can't come to you and then you write a check to the charity, but if it goes directly from the IRA to a charity and it's done the right way, made out to them, sent directly to them, and all the right information is on it, then you don't pay any taxes on that money that you gave out of your IRA to the charity. So that can be a really good thing to check into. And so read up more on that. And a great place to do that is by going to retirementtalk.com and learn more.